Good day, everybody. I'm Julia, and I'm here with Tony and EJ, and we're here to discuss problem set one, the analysis of financial statements. To start, we're going to be filling in first the balance sheet and income statement blanks. The first one is the total current assets. To get total current assets, we just sum up all the three rows above it, which is cash, accounts receivable, and inventories. Next, to get net fixed assets, we get the gross fixed assets and less the accumulated depreciation. Then the total assets is the sum of the total current assets and the net fixed assets. Next, we move on to total current liabilities, which to get that, we just add up accounts payable, accruals, and the notes payable, which is the three rows on top of it. Then to get total common equity, we add the common stock and retained earnings. And then finally, to get the total liabilities and equity, we add the total current liabilities, total common equity, and the long-term bonds. Now, for the income statement, to get the total operating expenses, we add the cost of goods sold and the other expenses. Then to get the earnings before interest, tax, depreciation, and amortization, or the EBITDA, we do sales minus the total operating expenses. Then to get the EBIT, we just get the EBITDA, then minus the depreciation and amortization, which is given, then minus interest expense to get the earnings before taxes or the EBT. Then to solve for the taxes, we just get the EBT times zero point 0.4 since tax rate is 40%. Then finally, to get the net income, we just minus the taxes from the EBT. And that is it for the income statements. So moving on, we can now answer the ratio analysis. The number one is to get the current and quick ratio or the liquidity ratios. This gives us an idea of the firm's ability to pay off debts that are maturing within the year. First is the current ratio. The current ratio is equal to current assets over liabilities. So we solved for those earlier, and from that we get these values. And as you can see, in 2016, it's 2.3, and it is lower than the industry average of 2.7. Next is the quick ratio, which is the ability of the firm to pay off debts without selling their inventories. So that's current assets minus inventories over current liabilities. And as you can see again, we get values that are lower than the industry average. And if it's lower than the industry average, it usually means that the company is in not a very strong liquidity position. And that is it for number one.
Okay, so next we move on to the second set of computations, which involve asset management ratios, namely the inventory turnover, the day sales outstanding, fixed assets turnover, and the total assets turnover. So these measure the effectiveness of a firm's management of their assets. So first for the inventory turnover ratio, this is computed by having sales divided by inventories. So when taking the values of the year 2016, this will give us 7,035,600 divided by 1,716,480, which would yield us about 4.21. So given that the industry average is, in this case, would be 6.1, which is greater than De Leon's inventory turnover ratio, this means that the company has too much inventory at hand. So next for the day sales outstanding ratio, this is derived by dividing the company's receivables by the average sales per day or the annual sales divided by 365 days. So this is done by inputting this formula in Excel using the 2016 data. And so we arrive at 878,000 divided by 7,035,600 over 365, which is about 45.5 days. So with an industry average of 32 days, would mean that De Leon is experiencing a longer time in collecting cash from its customers. So this could be due to their customers not paying on time. And so moving on to the fixed assets turnover ratio, this can be computed by dividing sales by net fixed assets using the 2016 data. We arrive at 7,035,600 divided by 817,040, which is approximately equal to 8.6. So given that the industry average is about 7, this would show that the company's fixed asset turnover ratio is higher and would mean that the company uses their fixed assets more than those in the same industry. And then lastly, for the total assets turnover. ratio. This can be computed by dividing sales by the company's total assets. So using the data, this will give us 7,035,600 divided by 3,497,152, which is equal to about 2. So noticeably, it is slightly lower than the industry average of 2.6. So this means that the company isn't able to generate sales in relation to its total assets. So for the third set of computations, we will run through the debt management ratios, which is these measure how effectively a firm handles its debt. So for this set of data, we will be specifically handling the debt to capital ratio and the times interest earned ratio. So for the first one, for the debt to capital ratio, this can be computed by dividing the total debt by the sum of the total debt and total equity. So by looking at 2016 data, the total debt would only include those of long-term in nature because the ratio only assesses a company's capability of meeting its long-term financial obligations. This provides a clear image of a company's long-term financial stability. So total debt would include notes payable and long-term bonds. By inputting this data into Excel, we arrive at 300,000 plus 400,000 divided by 300,000 plus 400,000 plus 1,952,352. This would be approximately equal to 26.39%, which is lower than the industry average of 40%. This means that the company has a higher cushion against creditors' losses when liquidating. And then lastly, we have the times interest earned ratio. This is computed by dividing the EBIT or the earnings before interest and taxes by interest, charges, or expense. With the data, this will give us 492,648 divided by 70,008, which is equal to about 7. This is slightly higher than the industry average of 6.2 and means that the company has enough cash to further invest after paying its debt.
Okay, so let's move on to number 4, or the profitability ratios, which show the effects of liquidity, asset management, and debt on operating results, as discussed by Sir. So first, the operating margin is basically the ratio of the operating income, or EBIT, over sales. As discussed earlier, EBIT is calculated as sales minus the total operating expenses and the depreciation. So inputting that in Excel gives us 492,648 over 7.035600 million, or around 7%. This is a bit lower than the industry average, indicating that operating costs may be high. Okay. Next, the profit margin is computed as the ratio of the profit, or the net income after taxes, rather than just the operating income, over sales. Inputting this in Excel gives us 253,584 all over 7,035,600, which is around 3.6%. This is slightly higher than the industry average. Next, basic earning power is the comparison or ratio of the company's income to its total assets. The income in this formula is the EBIT, or the operating income. So in the Excel file, this is 492,648 all over 3,497,152, which is around 14.09%. This is lower than the industry average, indicating lower turnover ratios. Next, the return on assets is similar to the BEP, but it uses the net income after taxes. So in the Excel file, this is computed as 253,584,000 rather than the 492, all over 3,497,152, which is around 7.25%. This is also lower than the industry average. Next, the return on common equity measures the profitability of a company compared to its shareholder equity and is calculated as the ratio of the net income after tax over the common equity, which is the sum of the common stock and the retained earnings. So in the Excel file, this is 253,584 all over 1.952352 million. This is 12.99% or almost 13%. which is also lower than the industry average. And lastly, for the profitability ratios, the return on invested capital evaluates the efficiency of the returns for equity and debt capital. So this is the ratio of the NOPAT and OPAT, or net operating profit after taxes, which is calculated by taking the EBIT and applying the tax rates to it all over the sum of the equity and long-term debts, which is the common equity, long-term bonds, and notes payable. So in the Excel file, this is calculated as the EBIT, so 492,648 times 60%, which is 1 minus the tax rate, all over 1,952,352 plus 400,000 plus 300,000, or around 11.14%, which is also lower than the industry average. Okay, so for number 5, we'll be looking next at the market value ratios, which are the ratios that relate the firm's stock price to its earnings and book value. First, the price to earnings ratio is calculated simply as the ratio of the price per share to the earnings per share. In the Excel, this is $12.17 over $1.014, which is around 12. This is lower than the industry average, so it indicates that the company's shares may have poor growth prospects. Next, the market to book ratio compares the market price over the book value for each share. To get the book value per share, the common equity is divided by the shares outstanding, giving us the value of $7.81 as shown in Excel. Finally, the market or stock price over book ratio for 2016 is shown in the Excel file as $12.17 over $7.81, which is equal to around 1.56. This is lower than the industry average, confirming the same conclusion as the price to earnings ratio. So that's it for number 5.
And finally, we move on to number 6, which is the DuPont equation, which helps us see how the different ratios determine the return on equity, or ROE. So we moved all the needed information down here just to make it easier. So what we need is the net income, the sales, the total assets, and common equity. To start, we get the profit margin, which is given by net income over sales. This measures how much net income or profit is generated as a percentage of revenue. Then we get the total assets turnover, which is given by sales over total assets. This shows the efficiency in which a company uses its assets to produce sales. And last, we get the equity multiplier, which is total assets over common equity. Here, a high equity multiplier indicates that a company is using a high amount of debt to finance its assets. Now, using these 3 formulas, we input the given as necessary, and we get the following values. Then when we get these 3 values, we multiply all 3 values together to get the return on equity, or ROE. And finally, we have to provide a summary and overview of De Leon's financial condition as projected for 2016, using the values we computed. Here we find that in 2014, although below the industry average, the company was in a relatively healthy financial condition given the positive profit margin. The performance of the company significantly declined the following year with a negative profit margin and a higher equity multiplier. For 2016, the financial condition improved, which can be attributed to higher and above average profit margin. However, the asset turnover and equity multiplier remains low, and the ROE still follows a declining trend, remaining below industry average. Thus, the company can look into these different factors and look into improving the values that affect the ROE the most. And that is it for Problem Set 1. Again, this is Julia, Tony, and EJ. Thank you for listening.